Well, let's begin this segment with the world business today. Now, the news business week is taking off on a bittersweet note around the world, while China leads the Asian markets to another negative close by 5.3%. The stock markets in Europe brushed off China in early trade with green numbers, but started trending into red in afternoon trade. From the currencies market, the South African rand loses nearly 1.5% to the US dollar at 16.56 parity as emerging market slump anchored on China's scares investors. Meanwhile, crude prices follow the Asian market's Monday rout as seen in the US. Oil prices trading at $32.56 a barrel, down some 2.35% at lunchtime here in Nigeria. An Asian market swept lower today after Wall Street suffered its worst starting week in history, and doubts over Beijing's economic competence sent investors into the arms of the safe haven yen and sovereign bonds. The absence of Tokyo for a holiday only made liquidity even harder to come by, heightening volatility.
At market opening, South Korean shares fell, led by concerns about China and caution ahead of earnings later this month. The Korea Composite Stock Price Index slid 0.6% to 1,906.56 points. Decliners outnumbered advancers by 5-3. In Hong Kong, the Hang Seng Index dropped 2.5% to 19,952.63 points, while the Hong Kong China Enterprises Index lost 3.5% to 8,539.73. China's major stock indexes opened down after weak December inflation data was released at the weekend. The CSI 300 index fell 1.7% to 3,303.12, while the Shanghai Composite Index lost 1.7% to 3,131.85 points. Jeff Lewis, market strategist at Manulife Asset Management, attributed the crash to heavy government intervention last year.
Well, I think the crash that we've seen in the mainland equity markets took everybody by surprise, but it was more or less a direct result of the heavy-handed intervention last summer, particularly the lockup of so many shares by institutional investors, which some estimates put as high as 1.2 trillion renminbi. That's approximately 8% of free float market cap. Even if only a small percentage of those institutional investors would have sold at the end of last week, that would still have been a significant selling pressure. So that made it rational for retail investors to want to exit the market first. So a direct result of the very inappropriate market interventions we saw last summer. The Chinese economy is not particularly sensitive to gyrations in the stock market. When the A-share market will stabilize is difficult to say. It surprised me that sentiment seemed to recover so strongly in the autumn, and again margin financing was increasing, and it looked like retail investors had recovered confidence in the market. That confidence proved to be very, very fragile, as we saw ahead of the expiration of the ban on large institutional retail selling.
In Shanghai, this 67-year-old investor was unhappy with the recent stock market turmoil.
Chinese stock markets mechanism are medium and small investors based, not like overseas stock markets mechanism. So policy should take the interests of the vast majority of investors into consideration, which are important to support the markets.
Australian shares plunged to 2.5-year lows. The S&P ASX 200 index crumbled 1.6% to 4,911.4. The benchmark shed 5.7% last week, its largest loss since 2011 and the worst opening week on record.
Tighter public spending, economic diversification and greater regional trade are needed to spur growth in Central Africa. That has been hampered by plunging oil prices and security threats. And that's according to the head of the International Monetary Fund. Ms. Lagarde, who met with Cameroon's finance minister and on her official visit to the region, said oil price that has dropped in recent months owing to global oversupply is creating a challenge for countries in Central Africa whose economies rely largely on oil exports.
The IMF chief, who arrived in Cameroon on Thursday, was speaking during a regional tour, where she said growth in the resource-rich CEMAC bloc comprising Cameroon, Central African Republic, Chad, Congo-Brazzaville, Equatorial Guinea and Gabon slowed in 2015 to around 2% and will increase only slightly this year. Lagarde said the prolonged slump in oil prices presents a new reality for CEMAC, and an adjustment in large-scale investment plans may be necessary in the short run to preserve fiscal viability and debt sustainability in the medium term. Oil has dropped from over $100 a barrel in June 2014 due to global oversupply to around $30 a barrel last week for countries in Central Africa whose economies rely largely on exports of oil.
Some have been hit harder than others. Equatorial Guinea experienced a severe contraction, while Cameroon saw some robust growth. The challenges, the external shocks the country is facing, the resilience of the Cameroonian economy, and the need to apply rigorous discipline both in terms of income and expenditure.
Economies have also been hit by security concerns, particularly from Islamist militant group Boko Haram, which has carried out attacks in northern Cameroon and elsewhere, disrupting economic activity and diverting spending from social programs to the military. According to her, an ambitious reform agenda will be needed to bolster growth, which is estimated at 2% for 2015, down from earlier estimates of over 4%. The bloc's fiscal deficit is seen to have widened 6.5% of GDP in 2015, with only modest improvement expected in 2016. The bloc's growth is expected to hit 3.5% in 2016, still far below the growth of the previous years. She held meetings with Cameroon's finance minister, Alamine Ousmane May, and other officials.
That was a very productive meeting. I was able to reiterate to the Minister of Finance that clearly the IMF is willing and prepared to partner with Cameroon by way of technical assistance and policy advice.
She urged CEMAC members to rein in spending to reduce deficits during tough times and increase regional trade.
And in the U.S., the President Barack Obama has praised car makers for strong industry results in his first weekly address on Saturday. Automakers last week set a new U.S. sales record for 2015, even as December sales fell short of expectations, and most forecasters said sales should rise to another record this year. According to Auto Data Corporation, for full year 2015, U.S. sales hit a record of 17.47 million vehicles, breaking the mark of 17.41 million vehicles in 2000. Low gasoline prices, easy credit, and moderate economic growth boosted the industry. The industry has steadily recovered since 2009, when sales hit 10.4 million vehicles, the lowest level since World War II, adjusted for population.
The auto industry would have to truly change, not just pretend that it did. We got labor and management to settle their differences. We got the industry to retool and restructure. Everyone had some skin in the game. Our plan wasn't popular. Critics said it was a road to socialism or a disaster waiting to happen. But I'd make that bet again any day of the week, because today the American auto industry is back. Since our plan went into effect, our automakers have added more than 640,000 new jobs. We've cut the Detroit area unemployment rate by more than half. The big three automakers are raising wages. 7 years ago, auto sales hit a 27-year low. Last year, they hit an all-time high.
Meanwhile, automakers are preparing to woo global consumers with their latest line of vehicles ahead of the annual North American Auto Show in Detroit. Mercedes-Benz presented the German automaker's new E-Class sedan, touted its autonomous driving capability coupled with luxurious offerings.
The new E-Class sedan will offer so many advanced driver assistance technologies. Dieter Zech, chairman of the board of management of Daimler AG and head of Mercedes-Benz Cars, says with just a few software changes, the car could be allowed to drive itself hands-free.
It's, of course, still restricted by legal requirements, but it basically is capable to be more or less fully autonomous, at least in freeways. And we got as a first production car a test driver license for a production car in Nevada to go fully autonomous with the car as it is sold to our customers.
Zech also said that the vehicle has been given the green light for full autonomous testing in Nevada. He also explained how Mercedes plans to better compete with rival German automaker BMW, currently the #1 luxury brand manufacturer.
Just continue what we are doing. Last year we passed Audi and came awfully close to BMW on a global basis. We do believe that we will continue to have great new products coming to the market with high acceptance by the customers. And that's what on the one hand drove our profitability ahead of the two competitors and which will drive our volumes further. And the target was 2020. We are very close already in 2015.
Forecasts for the widespread adoption of autonomous cars range between 5 and 20 years away. Also unveiled was the Buick Vista Concept Coupe. The concept vehicle has a twin-turbo V6 engine with 400 horsepower credentials with a sporty, sleek design. Rebecca Lindland, an automobile analyst for Keeley Blue Book, says technology, design and safety will all be highlighted during this year's auto show.
What we're trying to do at the auto show is show consumers all the new innovations, all the new technologies that are coming out and the new safety features. So I think that's what we're going to really focus on in the auto show.
The Detroit 3 automakers raked up record sales and profits in the U.S. market last year, not because of electric cars or plugged-in hybrids, but because of soaring demand for pickup trucks and sport utility vehicles fueled by gasoline prices that hit multi-year lows. With oil prices expected to stay low for some time, all the major automakers are looking for a bigger slice of U.S. truck market profits.
Let's go driving hands-free. More to come on Business Incorporated. Do stay with us.